Without further ado, let's kick off. So, welcome to this Bound webinar. I'm Eleanor Hill, financial journalist and podcaster, and I'm delighted to be your host for the next 45 minutes as we dive into how high growth companies with small finance teams can effectively navigate the complexities of operating across multiple countries and currencies. And I'm delighted to say that to help us on this journey, we have three expert panelists joining us today. They are Juho Ladenperä, who is CFO at Element, Nick Poynton, who is CFO at Arkit, and Marita Cavalcanti, who is CFO at Bound. And I'll just ask them to briefly introduce themselves, tell us a little bit about their story and their company. So Juho, over to you first, if that's okay.
Hi everyone. So my name is Juho. I work as the CFO at Element, the secure sovereign collaboration platform. I've been here for 3.5 years. This is my fourth CFO role. So I've got rounded experience of international operations. I was born in Finland. I live in the UK, and I've also lived in the US and Japan before. It's probably enough about me.
Superstar. Thank you, Juho. Nick, over to you.
So I'm Nick Poynton, CFO at Arkit, a US listed business. We listed through the SPACs in 2021 with all the insanity that went along with that year. My prior two roles to that were I was VP Finance at King, with the company behind Candy Crush, which was an amazing international journey there. And then in between those two roles, I was at Privitar as CFO, another software startup. We never got to list them, unfortunately.
Brilliant stuff, Nick. Thank you for that. And Marita?
Yeah, hi, it's Marita here. I'm the CFO of Bound. I'm essentially fintech CFO with a background in investment banking. So have been at Lehman Brothers for too long and then Nomura after the disaster happened. But for the last, call it 10 plus years, have had various roles in startups, scale-ups, mainly fintechs, such as Ebury, Ogno, Opportunity. And I'm in my second role as CFO, was at Opportunity before, and now at Bound for last 2.5 years or so, and really looking forward to this webinar today. I'm, as you can probably tell by my lovely accent, originally German, but have been in London for the last 20 years or so.
Great stuff. Thank you, Marita. So we've got absolutely loads lined up to talk to you about today, but we would also love to hear from you, the audience, as well. So if you've just joined, if you missed what I was saying at the beginning, you can pop your questions to the panel as we go along. Just use the Q&A button at the bottom of your screens. So that's not the chat button, it's the Q&A button, and we'll get to as many of those questions as possible towards the end of the session, but keep them coming throughout and I will keep an eye on them. But enough from me, let's get started and set the stage for this discussion. So obviously we're here to talk about managing finances across borders. I don't think anyone is going to say that this is straightforward. In fact, it's often pretty daunting, especially for high growth companies, especially for people without huge resources. But coming to each of you, what would you single out as the biggest challenge with multi-country, multi-currency operations and why? It might not even be something obvious, always open to something controversial as well. So Juho, let's kick off with you.
If I think of my stakeholders and the expectations from the business, really, it all starts from having the right amount of cash in the right currencies and right accounts ready for the business. So you're providing that basic need of, okay, we're going to be able to pay our bills. We know where the cash is, and running that as part of an efficient, ongoing process to enable you to earn a return, as well as making sure that the business is doing well.
Yeah, that makes complete sense. I think we'll dive into that a little bit more shortly and how people can hopefully go about managing that and getting things in the right place at the right time, as you said. But Nick, for you, what's the biggest challenge and why?
Well, I think when we're moving into new territories, it's clearly usually sales driven or development driven. And so you sort of, setting up a beachhead in a new territory. And you end up immediately with a conflict of regulatory environments you've got your own regulatory environment at HQ, for want of a better word, and then you've got the regulations in the organization, in the territory in which you're landing, and they are often not very compatible. And so how do you set up in a new territory, whether it's setting up subsidiaries and hiring people in and setting up payrolls or hiring them through consultancy agreements and whatever, there's a whole mishmash of complexity that is different for every country and every pairs of countries.
Yeah, yeah, absolutely. And again, we'll dive into that more shortly, but you're right to focus on that side of things as well. It's not just about the actual finance function. There's broader business things to consider. Marita, what would you add in?
Yeah, just to add, in my experience, international expansion can be extremely costly. And in many companies, it does happen more ad hoc than planned.
Yeah,
So what I would say is that it's certainly worth doing a bit of prep work and planning before getting thrown into the deep end, particularly if you go for markets that are quite complex, such as the US, which really is not one market, but if
yeah.
you work in a regulated business, quite a few states that you would need to seek regulation in. So just make sure you know what you're getting into before you're doing it and have some way to track that once you're in it.
Yeah, hopefully you've got a little bit of warning, like you say. It's not always terribly planned in advance, but yeah, always best to be prepared if you can. I wanted to come back to you and dig into the what you said about having the right balances, the right countries, the right currencies at the right time. When we look at all of this, managing international cash flows, particularly forecasting international cash flows. I mean, I've been writing about this for 17 years and I've never found anyone that said it's easy, and I've never found anyone that's managed to do it perfectly by any means. But any tips that you can share to start us off? We'll go into the details a little bit more later on the FX side, but what have you learned over your journey that's worked well and maybe what hasn't worked well?
Well, I've tried a few different things, and the way we do things here at Element now is we have a weekly process to run cash forecasting for each of our entities, and we have 4 entities in different countries, and as part of that, we can forecast the incoming receipts from customer invoices and the expenses and payments out. They're quite easy to forecast as they're predictable, and we can forecast that from the supplier invoices that we have and the knowledge of the business. So on that basis, we can create a relatively accurate forecast on what our outgoings are going to be, also by account and by currency. And that helps us to manage then a weekly process of making payments and collecting funds from our customers, and really run a controlled process to ensure that we have the liquidity where we need. And when we have excess liquidity, we're also aware of that ahead of time, and we can then deposit those funds to earn interest and make a return on them. And it gives that foresight into what you might need. And so that weekly process there around, if you have the cash forecasting, you can then build your business process around it, around collections, around managing your liquidity, and around also your payment run, which we do once a week, which is kind of nice because you don't have to do it every day.
Yeah, is everyone quite compliant with what you need for that? And it sounds like you've got it fairly well under control. It's not
It,
always the story that I hear from
yeah,
everyone I
it,
speak
it
to.
probably takes about 2 years to get the business ready for it. That it's not
Okay.
just like a reactive, we just pay bills whenever. But
Yeah.
once they get used to it, they know that it's there, it's part of the structure and routine. And it really reduces the amount of errors that are made, since if
Yeah.
you're just, having to go and make emergency payments here and there, that's when you can easily make an error. And
And
that then is costly and annoying when it
yeah, oh yeah, and familiar to many of the audience, I'm sure. But you mentioned that it took about 2 years. Was there anything in that process? Like, was there a particular way that you went through kind of training them, I'm going to call it? Is there anything that might be useful for others to know, or was it just very much an incremental process?
It was an incremental process. We started off by really working in the cash flow and building that knowledge and experience within the team.
Yeah.
And if the team members, when they're doing something new, it's always a different perspective. So understanding how that's important and using that as integral part of the process, the way we work, has really been the cornerstone. So you're bedding it in and making sure that you're in a place where you get to the understanding of how it's actually being used, so people see the value of doing that. Another
Mm,
thing that we've done then is that we've kind of designed, based on that data we have, is the kind of a minimum balance that we hold on each of our kind of non-central accounts. So we have this kind of a treasury function effectively in the headquarters, where we keep all the extra money that we have, where all of the smaller accounts have got enough liquidity there to last them for between 3 and 4 weeks. So we
okay.
are always in a place where we are managing forward the cash flow there. So we're not dependent on, there should never be a crisis, because even if you
Yeah.
miss a week of doing the review, you have enough cash in that entity to support any direct debits or any payments that might go out, even if you are not able to do a transaction for a week or something like that.
That makes sense. Yeah, just have a bit of a buffer there just in case.
Yeah, but it's really about building that knowledge around, how the business is working, what are the expectations around cash flows, and getting the team on board. I think the external stakeholders around from other teams around the finance, they're just happy if they can feel confident and there's a structured process. And it's really about education to get them used to that weekly cadence.
Yeah, because it can seem quite opaque to some of those other stakeholders. And like you say, it's just making them feel comfortable. Marita, would you agree with that? What would you add to that? You've probably, knowing you, got some kind of bits of that you'd like to automate if you possibly can. Any experiences or wisdom you can share with us?
Yeah, look, I think what you had mentioned is the absolute key. You need to be sure that you have the right liquidity in the right currency in the right accounts ultimately. Otherwise, there are problems. So the better you can forecast that, the better you will run your finance teams in the end, and your finances and your suppliers and customers and everybody else and employees in all the various territories will be happy. If we zoom out maybe a little bit from that, what we're trying to do here at Bound is take out any unwanted volatility that happens behind the scenes with currencies moving up and down. Because one thing is obviously to forecast, okay, I need whatever, €1 million next week for payroll in my German bank account, something like that. The other thing is, what does that €1 million cost me in my home currency in pounds? So the reason Bound was set up about 4 years ago is actually to make foreign currency conversions and hedging accessible to all companies. I've had, I think, too many conversations in my life and experiences where hedging hasn't happened properly.
Yeah,
and it's very difficult to, and it's a complex topic. So what we're trying to do here is really, in a way, dumb it down, make it super easy, transparent, obviously competitively priced, so that anybody in any company can hedge their exposures fairly easily. It's just taking out unwanted volatility. That's really all it is. But I would fully agree with you, Ho, that the liquidity planning and budgeting is absolutely key. So the more precise you can be on that, the better. Then second to that, it's also not just maybe for the next week, but look out for the next month, quarter, or up until year end, what the plans are and what you think you're going to have in terms of exposures. Take both costs and income into account, because there might be some natural hedges that you just have and you don't have to hedge out externally. Anything you can do internally, always better, right? And then in addition to that, most companies of some scale do have assets and liabilities in other currencies as well. You might have a venture debt taken out in dollars just because that was where you could get the most leverage, or you have a subsidiary in wherever, Thailand for argument's sake, and that's going to move in your balance sheet by year end. So just be aware of the risks you have. It's not a super easy topic, but I think there are quite a few tools to help you figure out the exposures, and then with Bound you can manage it fairly easily.
Yeah, and we'll talk a little bit more about this shortly and get onto all of the FX side of things, and no doubt delve into the Bound story a little bit more. But Nick, I want to bring you back in here because you alluded to some of those challenges of setting up overseas and having international subsidiaries. You've experienced some fairly hard-learned lessons here, I know, because we had a good chat before this webinar. Just tell the audience a little bit about some of the risks that startups face when they're setting up overseas offices and maybe doing it too early.
Well, so like I said in my introduction, we went through a SPAC in 2021, and we came out of the other side of that with a big pile of cash, and sort of thought, right, now's the time. I'm going to grow, expand overseas, and this is a product we're selling and everything. And we were pushed quite strongly by our CEO at the time, who was very enthusiastic and very bullish about how our success was going to work. And so we ended up setting subsidiaries. I've got a full list here, actually, in Singapore, Italy, Australia, and then there's a joint venture in the UK, and then there's some other UK entity that we had to set up, none of which have been used in fullness of time. Most of which was mainly because our product changed as we matured. We realized that the direct selling to enterprises was not the way to go. We're going to be selling through partners, and that requires a completely different legal structure, and it doesn't require in territory individuals, which therefore means you don't need entities and bank accounts and payrolls and all the sort of local registrations for taxes and so on. So by the time we'd set up all of these entities and then unwound them all, which we just finally finished last week, I was checked on Companies House. The last company was killed off last week. We've probably wasted north of $250,000 just in fees and setting stuff up. Now, in the grand scheme of startups, you can waste a lot more on in other directions, but it's frustrating when there was really a more sensible alternative, which was hire and develop in line with your success. Don't anticipate your success. As a sale comes up, then you set up a subsidiary or you hire the individual that's going to be your salesman in territory. There's a more measured way of doing things. Don't get excited and just go nuts.
Don't get too over the top, yeah. I'm sure we've all felt those urges to do so, but yeah, it's caution pays off very much in this situation. Nick, we'll come back to that a little bit later and some more of the lessons around it, but I wanted to focus on the budgeting side of things and the FX and look at some of the risk mitigation that we've kind of alluded to as we were going along. So Iho and Marita, coming back to both of you, the budgeting FX rates is kind of often it's not overlooked by startups or it's not given as much attention as it should be because obviously everyone's got priorities elsewhere. What do you think they can do to make budgeting a proactive part of their strategy from a CFO point of view? How can we help the audience to do a little bit better around this? You hope?
Well, yeah, I find it really interesting why this is, it's not an obvious thing to do is to have an FX budget, and it's probably because it's such an implicit cost of doing business, and you don't really see it, and you really need to go out of your way to calculate what is the FX loss or gain on versus what you were forecasting at the time, and maybe the tools that are available, they're not so easily understood, and they're kind of when you're going through training and schooling, is not something that is first come to mind.
Yeah.
So I think obviously we all know that if you start looking at your exposures, and you have some foreign currency exposure, that can have quite a material effect on your results in the year. And you as the finance team, you don't want to be dependent on hitting your numbers on FX moving the particular way, since it can easily move the other way as well. We just don't know. And taking that stance and starting to look at what are my exposures and evaluating that is a really great starting point for getting going.
Okay, and we'll talk a little bit more about the first steps around that in a second, you hope. But Marita, I'd love to hear your thoughts on that and why it's not as common as maybe we'd like it to be.
Well, I think it starts where Nick started with his story, that you enter a foreign market and suddenly you're 250K down, right? So
yeah.
That frankly should not happen, no, unless you budgeted for it and unless you made a very conscious decision that your budget to enter the US is $3 million, whatever it may be, right? And I think the first step is to really set a proper budget, and that should be obvious, and that should be in the executive team discussed and be a plan for the year or the next couple of years, however long you can actually strategically plan ahead for, and say, okay, we're planning to make X in this amount of time, and we are spending Y against that, and that makes everybody happy. But as soon as that goes out of kilter, you should actually decide whether you pull back earlier, or if it's going super well, maybe you double down and you disregard your home market a little bit more because everything else is better elsewhere. So I think it's just important to have a real proper plan and have measurable KPIs. I mean, I hate to always come back to numbers, but I'm a numbers person. I think in a lot of the corporate management things do go down and come down to numbers. So finance teams are, for me, really center stage. So hopefully that makes everybody on the call feel a little bit better if they are from the finance function. But you do have to drive and provide those data points to the whole management team so you can actually make decisions that are in line with what you're expecting, wanting to achieve, et cetera, et cetera. And then on the whole FX management bit, just make sure you have it sorted. It is an afterthought. It is not, we're going to grow revenue 2x next year, and FX is maybe can destroy that by 10%, 20%, 5%. Just don't do it. I mean, just have it sorted. So it's so easy to do that. I wouldn't even risk it.
Yeah.
But like everything else also obviously needs to flow.
Yeah, but like you say, it's rarely kind of front of mind and it's often an afterthought for people, but so easy to fix, which we'll talk about a little bit more in a minute. But Yuho, coming back to you, for those on the call who haven't done a lot of FX budgeting, just talk us through a little bit, some first steps that they could take, just make them feel a little bit more confident with that process.
Yeah, sure. So once you have your budget done, and you can do a quick estimate around what is your currency exposure by taking your income in each currency, doing an estimate on that, basically based on what your plans are for growth and where you have your customers, and then looking at your costs by currency. And if you sum those two together or see the difference, then you know your kind of likely net currency exposure by country. Give you a first idea. And if you look backwards then and see how those currencies have moved against your base currency, you can see what could be a potential exposure or gain. It could be either way that you could get if the currencies moved against you. And that would then, what I would recommend doing is just really having a think around how much risk do we want to take here? Is this core for our business? Do we think this is something that we really want to avoid? Are we happy
Yeah.
to take some level of risk? And that really should be a senior management discussion so that they are aware and they also know how this is impacting their performance and the potential exposure that is there. And once you get that done, then you kind of have a shared understanding of what is the risk here and what you want to do about that.
Yeah, it really helps having, like you say, management on the same page and then making those decisions going forward. But just a quick reminder while we're here that you can submit your questions for the panelists as we're going along. So use the Q&A button at the bottom. We'll get to some of those in a moment. But yeah, just anything you want to ask, anything that's come up already, or anything that you came to the webinar wanting to find out. No question too silly. You could submit them anonymously. So just get them in and we will answer as many as we can. But Nick and Marita, I wanted to talk a little bit around the sort of human side of FX because a lot of people look at it and they take a position on the market or they have these kind of ideas that they want to play the market a little bit, not necessarily CFOs, but certain people involved in that. How much do you think the biases that we have in decision making impact FX and other risk management decisions? And how can we look to tech, things like automation, digital platforms, to make sure that finance teams are actually making much more objective decisions than rather than taking that human slant on it all? Nick?
Okay, well, so with another cautionary tale about how to get things wrong because of personal bias, I think is back in 2016. This is actually a personal story. I had a small amount of US dollars in my own account, and because of the access to, I was at King at the time, because of the access to our bankers' reports, I was monitoring the USD GBP rate a lot on a daily basis and run up to the Brexit vote. And a week before, the bankers' reports were basically saying, we're not too sure which way it's going. If the vote's in favour of remaining, then we're going to see the pound strengthen. If it goes against, we'll see it dropping. Right now, it's sort of halfway between those two extremes. It's on we have no idea what's going to happen. And I was so convinced, I mean, I was part of that London bubble, like I'm sure a lot of people here, that there's no way on earth the British population was stupid enough to vote for Brexit. Sadly, I was wrong. But that cost me a small amount, but it was a very, very clear indication that I had impartial, proper considered reports in front of me, and yet I took my personal bias to say I can beat this because I can't, but
Yeah.
and quite frankly, what I should have done is do half before, half after, and I would have averaged the difference.
I know the benefit of hindsight, though, and like you said, oh, Brexit is still so sore for me. We need another 45 minutes to talk about it. Nick, any advice on the kind of automation or digital side of things, or shall we let Marita take
I'll
over?
probably let Marita jump in on that, but yeah, there's one of the questions in the Q&A I'll jump in on later, but
Okay, brilliant. We will get to those shortly. Marita, give us your thoughts on that bias side of things and why we should be maybe automating to help get rid of that.
Yeah, so maybe first of all, it's super important that we notice we do have personal biases, right? And that's probably pretty much everybody. I mean, what would markets be if not fun for a little bit of speculation here or there, right? So in the end, look, I've spent more than 20 years in capital markets and related areas, right? So in the end, what you do know is nobody knows where markets are going. If somebody tells you they know, they would be sitting on the beach, they wouldn't be talking to you. So pretty clear. So One, there are personal biases. I have my own. I mean, I used to work for Lehman. I did not predict that we'd go down on that lovely day a couple of years ago. So even with all the knowledge that I had, with all the conversations, with access to senior management, all that kind of stuff, I did not see it coming. It obviously destroyed all sorts of markets after, not just FX, but also equities, fixed income, whatever. So long story short, we should all notice that there are a whole lot of biases and nobody can predict markets, not equity managers, not FX research people at the various really good banks that do nothing else but try to predict the markets every single day, not the hedge fund managers who are super smart, super smart, right?
Yeah.
So they sit on one side and it's their job to put the algorithms in place to make money from, say, FX markets, for example. So if you're sitting on the other side of that as the poor corporate treasurer, CFO, whoever else who has a whole bunch of other things on their plate to manage on a day-to-day basis, do not try to time the market. That would be my number one advice.
Mm-hmm.
And there are tools that you can use. So one, please do acknowledge that bias. Don't try to time it. You will lose out more often than not. It should be a 50-50 game. In my experience, it's never been 50-50. Murphy's Law, maybe, whatever. Maybe it's my bad luck. But just take out the volatility, know what your budgets are, as Joho was also mentioning. What is my budget? What am I trying to achieve? Where am I happy? Not, let me sit it out. I think it's going this direction. And then, I got unlucky and the company's down the drain. So just put a couple of strategies in place. They don't cost much in terms of neither time, effort, nor money. So just sort it out. And then focus on the much more exciting things in the finance function that you can do, right? So you can be much more strategic if you actually know this problem is taken care of.
Yeah, absolutely. Like you say, there's no one that can properly forecast rates. And yes, we would be on a beach, and I would be on a beach in the south of France, but that's coming back to the Brexit conversation. So we don't want to go down that rabbit hole that Nick has now opened up in my mind. But Yuho, let me come over to you because you are very familiar with all of this, all of these challenges that have been going on. And you actually use Bound now to help avoid all of these issues that we've been speaking about. So maybe you can share a little bit with the audience the experience that you've had around that.
Absolutely, and so we use Bound mainly to kind of to hedge our currency exposure, for the 1 year outlook we have in front. So we're taking some FX risk, but we are diversifying our trading into daily tranches to ensure that we are avoiding that particular exposure to daily movements in the rates and hedging that. And if we have larger currency exposures transactions coming up, we then forward trade those to ensure that we know and we are hedged against any kind of unexpected movements there. So we're kind of reducing the currency risk. And when Marita was talking earlier, it really reminded me of that we used to use a broker before, and I used to trade once or twice a month. And I'd be looking at the FX trends when before calling them, and just I had this strange feeling around, why am I trading today? Is today a good day to trade? And it just felt me, like I just used to say that I don't know any better. The market knows the best. I'm just going to buy today. But it always left me with the feeling like the day that I choose to trade was really important for the business performance. You can easily lose. If you're doing a 100K trade, you can easily be 1% up or down, and that's £1,000 in or out for the business. And it was just pure luck. So what Bound is helping me to do is to reduce my exposure to that luck and to the day that I'm randomly choosing to remember to trade currencies. And that diversification is really helping us. We still do some spot trading, and I still have that kind of itchy feeling when I'm doing that, thinking, is it a good day or not? So I'm trying to avoid that as much as I can. And one of the improvements that we're thinking about is that really holding a little bit of extra currency so we can avoid that those spot trades that we still sometimes have had to do when we've had unexpected requirements. But that's kind of what we've been using it for, and I like the kind of predictable pricing and the transparent platform, which is easy to manage. So we don't need that kind of ongoing calling the broker and that sort of thing. But neither are we actively trying to game the market. We're not in the business of making money from FX. We just want to make sure that our business is running smoothly, and we got predictability in the way that our business and our costs are covering, and we can avoid any kind of major impact from the FX movements.
Yeah, that's exactly it. It's about the predictability, the stability, and not having that itchy feeling as you described it, which is, I'm sure, familiar to a lot of the audience, and those high heart rate notifications going off on the watches when you're looking at what's up in the markets. I'm seeing quite a lot of questions coming in, so we will get to those shortly. I just wanted to come back to you, Nick and Marita, very briefly on some of the pitfalls around being a startup and what you're looking at, and when you're trying to manage all of these things across multiple geographies, multiple currencies. I think, Nick, it's quite easy to get distracted by certain things, like maybe optimizing every penny, every cent. How would you say that the audience can strike the right balance between that risk mitigation side of things while focusing on growth?
Well, I think Yuho nailed it best with the way he was describing it. I mean, I think fundamentally the finance department should never be a profit center. If you see yourself as a profit center and bringing in income, you will take the company down eventually.
Yeah.
Right? You will screw up monumentally because you will lose money one day, try and get it back the next, and before you know it, you're like Nick Lehman taking down the whole bank, right? So our role in finance is simply to do the best we can and just be sensible and just optimize, well, not optimize, do a decent job on FX. Doesn't have to be the best. If you want to be an FX trader, the best thing you can do is get a DeLorean, get a flux capacitor, find a bit of road you can do 88 miles an hour on, and you can be sitting on that beach in a couple of days. But generally speaking, be sensible, use the tools that we've been describing here, and don't try and be a hero, because fundamentally your business is going to survive on whether you've got company sales and your revenue line's growing and equity value's going and everything else. No one's going to say, "Hey, brilliant, you got an extra $500 on that,
Yeah.
on that deposit." And sorry, another thought came into my mind, but this is sort of escaped.
No, you're fine.
Oh no, and I think one of the things that I'm sure you and Marita have had this pressure, which is you always end up with a very, very clever salesman who comes in and says, "Oh, well, look what I did at the weekend. I just did some FX trading and I did it a lot better than you."
Yeah.
And they'll walk around being smart. But the fact is, they don't come and tell you the day they did that wrong.
No, exactly.
And they lost money.
Exactly that.
And so there's always some smart ass in the business who wants to make out that they should be doing your job better than you. Well, that's not their job, right?
Absolutely. Marita, can you relate to that?
Yeah, absolutely. I'd love to be able to time travel and sit on the beach by now, but in the absence of that, let's face it. I like the idea of not seeing the finance function as a profit center in a way.
Yeah.
In a way, it's obviously sad because we like to be, superstars and all that. But probably the more prudent way is to really not be an isolated division trying to make as much money on your own as you possibly can and impress everybody else. Finance is a part of a wider management function of a company, and you should know your place in that and not feel alone and left alone, and decide as a management team or executive committee where you want to take the company to and how you want to do that. And hopefully that is in a more risk managed way on the finance side of things, and way more strategic and exciting side of things on the sales and outgoing effort side of things, and just create the appropriate tracking in terms of numbers, budgets, whatever comes with that, to really make those key decisions on where you want to take the company next together as a management team.
Yeah.
And then, unfortunately, you as the finance person will probably always have to remind people what the plan was, and on a whatever monthly, quarterly basis, say, "Hey, here's what we had planned for. Here's where we've gotten to. Should we continue? Should we double down? Should we retrace?" And then kind of be part of that team rather than the lone hero trying to make more money than the sales team out of finance function.
Yeah, absolutely.
It is tempting at times, I have to admit.
Of course it is. Of course it is. But I think it's more the narrative now that I'm having with a lot of finance leaders is, like you say, it's not about being a profit center, it's about being a value center. And that's very different, and that's much more strategic. And that's hopefully where all of this conversation is leading today. But I'm seeing the questions come in the Q&A. So let's pop over and have a look at some of those. keep them coming in while we're chatting, and we will get to as many of them as we can. So there's a few around the budgeting actually. So Yuho, probably some of these are going to be coming to you, but Nick and Marita just chime in, and then we've got some others coming in as well. So Yuho, when you're doing your budgets, are you doing budgets per currency first, then bringing them together for the overall budget? We just do combined budgets in our main currency. How do you deal with that complexity?
So for us, we do the budget in underlying currencies. So we have that on the cost side for sure, and on revenues, we're just estimating based on the pipeline that we have, as well as the customer base we have, because we know which currencies each customer is trading us with. So we do that, and then we kind of convert it into our base currency, which for us is USD, and do it that way. So that data, the financial model we have provides both views.
Marita, anything you want to add on that one?
Yeah, I've seen various models, to be honest. So you can either do it on a subsidiary basis, and then the subsidiary reports back to headquarters ultimately. So you have whatever your budget for the French entity, and that budget includes, okay, here are my foreign cash flows for that entity. Or you can do it more holistic and say, okay, I have all these subsidiaries and I combine the exposures of the subsidiaries, which in the end always happens regardless, because you do need to have the holistic view of every cash flow, hopefully, in every currency throughout the group. And then in terms of managing those, you could do it on a subsidiary level. I tend to recommend to do it on a group level, just because you will have natural hedges. So if you have, the French subsidiary with revenues in the UK and your UK headquartered company with, not only costs, but also revenues in euros elsewhere, it's probably easier to do it that way rather than do it on an individual flow basis. So if you have the systems to track foreign currencies properly, do it on a holistic way, I would say, rather than on every single cash flow in every single entity, every single time that occurs.
Yeah.
Because then you probably overhedge and you have too many volumes to deal with.
Yeah. And there's a question that's come in while we were speaking there, which is, how do you deal with the mismatches, especially when the big collections in foreign currency happen a couple of days past the deal date? Yuho, do you want to pick up on that one?
Well, for me, then there needs to be some slack built into the system. And we do that in 2 or 3 ways. So when we always have the monthly cash balance of it, like the 3 or 4 weeks cash balance available on our account. So we hold liquidity in those currencies to make sure that we're not dependent on any one transaction coming in. Clearly managing those collections and making sure that the timing. You can chase collections even before they are due, and getting to know when the payment date is. Then you can bring predictability.
Yeah.
And this cash forecast is also really great if you get into a more crisis situation. You can stretch it to be a daily forecast. I've done that in the past, not in this company but others, where we really are forecasting direct debits by day, and it really gets to that level of detail where you don't have a lot of liquid funds. You have the process ready to then go into more detail, but holding that extra liquidity there, that you don't have to really worry about the dates of each collection, is key.
Just give you that little bit of comfort and a little bit of leeway. Absolutely. Okay,
good
stuff.
That's how it goes.
Nick, there's a question which is around sort of subsidiaries in other countries. So I'm going to put it towards you, but would love to hear from the other panelists if they've got views as well. So what kind of strategies should be adopted when dealing with subsidiaries in hyperinflationary economies such as Turkey? Where should extra focus be centered on, and what should be monitored more rigorously? I'm now thinking about being a beach in Turkey. This whole conversation is taking me towards booking a holiday.
I'm afraid I don't really have much experience of hyperinflation.
Is the UK one as well these days?
You can't open up that can of worms, Yuho. Not when we've got 5 minutes to go.
Maybe not anymore. It's been down 2.5%. This month.
Does anyone else want to comment? Anyone have any experience, Marita?
So of course we had hyperinflation in Germany, but that was before I was born. But hey, we had it, right?
Yeah.
My husband is from Brazil. They had a ton of hyperinflation there, which in a way meant that actually the Brazilian payment systems are instant and very, very good. So that's I would say a benefit of having lived through hyperinflation. then you have markets like Argentina and Russia, which are every credit analyst's worst nightmares, because every couple of years they will default and the currency will go, down the drain, at least if you think history is any guide for the future. So for Turkey particularly, and countries like that, I mean, the best thing you can do if you are able to take the money out in a different currency and you don't have expenses against the money you are holding on account in those currencies, just take them back into your home country as soon as they arrive, or if you know they'll arrive, do that before via hedge if that market is open for hedges. So as much as you can control, do what you can do, and don't wait for the lovely Turkish lira to potentially appreciate against the pound, which may very well happen. Nobody ever knows, right? So random walks here and there, but don't bet your company finances on that happening.
Yeah. Good advice. Thank you, Marita. There's another question that's come in. Keep them coming. We've got like 3 minutes left. So if you've got one desperately burning, I will try and squeeze it in. What's the experience on FX rates that smaller companies can access and the inherent spreads we end up paying away to banks and brokers? Does anyone want to comment on that?
I could maybe do that. It's so I've used a number of different brokers and platforms. I think that the most surprising thing, when people start looking at this, is that if your mainstream, high street banks, they charge an arm and a leg for doing any foreign currency trade. So so you can really make things more efficient than by trading there. It can be up to 1% or even more in some cases where you pay that, and there's lots of different solutions out there. There's a cost of doing business and someone doing that trade for you. So I think paying something for that service is fair, in my opinion. And with brokers, if you're using brokers, it's almost it's sometimes really hard to know whether you are actually getting the margin or markup that they say you're getting, since that it's the comparing and benchmarking things is hard. So
every time they're on the phone, you're suspicious. That's what.
If they're calling you, you need to ask why they're calling you, because they probably have another client somewhere willing to do the opposite side of the trade, and they can match that, and then they're getting a good deal out there. So that might be a reason. But they, I'm not saying that they might have your interest in heart as well to make a good deal for you. So it's an interesting one. But clearly there's they're providing a service, they need to earn fees for that. So some level of fees is valuable.
Yeah, that's how business works.
I think I'll probably just follow up with something for you, what you have making, these sort of non-high street FX traders can be very, very, they offer very fine margins on their first few trades with you to sort of to net you in. It is always worth checking whether that hasn't sort of slipped back over time. They kind of, that bait and switch tactic of get you in, do a couple of months of being very, very keen, and then suddenly, if you're not on the ball, you'll be suddenly getting they'll be getting a slightly wider margin, and
consistent benchmarking is needed. Yeah. Oh, good advice, Nick. Thank you for that. So we're just coming up to time on the webinar. So let's do some quick key takeaways from each of you, because we've discussed so much today, and it would just be great to get a really succinct piece of advice from all of you. For our audience, our high growth CFOs out there, they're managing finances across borders. They've got a small team. What's your one piece of advice for them as we go into the rest of 2025? Yuho, let's come to you first.
Well, I would have to, I've said weekly cash flow forecast probably 6 times already on this call. I'd say you haven't already put that on your list of things to do, and it's going to be the backbone of your cash management.
Okay, brilliant stuff. Nick?
I think it's probably picking up on one of the outstanding questions there about budget rates. If you're going to try and come up with a budget rate in your budget model or your forecasts, you're going to be wrong, right?
Yeah.
If, again, going back to that sitting on a beach, if you knew it, you'd be doing something else. The question is, how wrong can you be acceptably? And using the same rate as today for the rest of the year is one option, or you can do forward rates or other ways of doing it. But whatever you do, you're going to be wrong. So you've got to accept that.
Yeah. And Marita, over to you.
I would say look at the known uncertainties of your business, look what they are, and try to manage them as good as you can upfront. Because if everybody just takes away from this call that there are ways to manage risk that you can implement now, do it. And yeah, don't wait for the time machine to arrive this year. Please don't be one of those companies that notice too late, and
Yeah.
Everything goes to bits around you. Things you cannot influence, right? None of us, I think, on the call can influence global markets. So let's not try to do that. And
No,
let's prepare for that.
Yeah, and the DeLorean is not waiting outside, I'm sorry to say, but hey ho. Good stuff. Thank you so much, all of you, for sharing your insights today. Really appreciate it. And it's been good fun, and hopefully the audience have learned a lot, and also appreciate the questions from the audience. So thank you so much. If there are questions that you popped in that we didn't get to, come back to us, find me on LinkedIn, find us online, and we will be happy to answer your questions for you afterwards. And if anyone wants to find out more about the solutions that we've mentioned today, if you want to find out more about Bound and how it can help reduce the headaches of managing multi-currency flows, head over to the website, it's bound.co, or find Marita or me on LinkedIn, and we will put you in the right direction. But for now, thank you ever so much again for everyone for joining, and this is now the end of the webinar.